Hey everyone, today we're diving into an exciting option strategy that can help you earn $10,000 a month with SPY Leaps. So, if you're aiming to boost your income, secure your financial future, or finding a way to replace your 9 to 5 income, this video is for you. Hi, my name's Gautam. I'm a former finance executive turned options trader. My goal is to help you escape the 9 to 5 grind like I did with the power of options trading. So if you're ready to change your life, hit that like button, subscribe to my channel, and let's get started. Also, don't forget to sign up for my free options newsletter, link in description below, where I share tips, tricks, and strategies to help you succeed. First, let's try to understand what SPY is. So the SPY is an ETF or an exchange traded fund that measures the performance of the 500 largest publicly traded companies in the United States. So let's go over to Robinhood and see what's in the SPY. It is a mix of technology, healthcare, communications, consumer defense, utilities, basic materials, consumers, cyclical goods, industrials, energy, real estate, and financial services. So the 30% of the SPY is focused on technology. If we come down here and look at the top 10 holdings in SPY, you have Apple, you have Microsoft, Nvidia, Amazon, Meta, Berkshire Hathaway, Alphabet, which is actually Google, Broadcom, and Alphabet C is also Google, and Tesla. Next, let's try to understand what LEAPs are. So, LEAPs are long term equity anticipation securities. And basically, LEAPs are option contracts or call option contracts with expiration dates that are far out in the future, generally 1 year or longer. They can be a perfect tool for generating substantial returns when used correctly, that is, with the correct strike price and expiration dates that we will be talking about in the next section. Next, we want to focus on choosing the right leaps to get this option strategy started. You want to look to buy the leaps at a good support level. Good support levels are 200-day moving average when the RSI is close to 30, bottom of Bollinger Band. And basically, the end goal is you're buying the leaps at a point where you feel the stock is down, from its all-time highs, where you have enough room for the stock to go up and make you some money. So next thing you want to look at when selecting your leaps is choosing the leaps with a delta of 70 to 75. I generally like a delta between 70 to 75. I think that's a sweet spot that gives you the best bang for your buck again. You want to obviously choose the leaps option that is 365 days out or more. That is basically giving you enough time in case the market tanks, goes sideways for a little bit. And that just means you have enough time to work your strategy. You want to look for a contract that has enough volume and open interest to allow you to get in and out quickly. So next we're going to go over to Robinhood. Actually, not Robinhood. We're going to go over to Thinkorswim and look for some leaps for the strategy. So I am logged in into the Thinkorswim platform right here. So we have SPY pulled up and we're going to go over trying to look at a year out from today. We can possibly go with the March 31st contracts or options chain, which is about 352 days, almost a year. So if I come down here, we said we want to choose options that are between a delta of 70 to 75. That's what I like. So open this options chain, see where we can get to a delta of about 70. So a 70 delta is actually the 500 strike price. Given that SPY is at 538 right now, and 500 being a nice whole number, there's good open interest in volume here compared to the other options. I'm going to go ahead with the 500 strike price. Yeah, you want to click on the ask, and we want to go ahead and buy 10 options. So generally, we have, a slight difference between the bid and the ask here. And if we go with the middle price, I think we should be able to get a good fill. I'm obviously recording this after hours, so we're not going to be able to execute the order right now. But just to show you, you could go with the price in between the bid and ask. So if we go with this price right here, this is 78.13 per contract times 100 shares per contract and times 10 options. So 10 leaps will end up costing us $78,130. So now that we bought our 10 leaps, let's see and understand how we're going to actually make that 10K per month. So the next step is selling covered calls to make the $10,000 per month. And A covered call is a strategy where an investor, which is you, sells a call option on any stock they already own. In this case, we will be writing covered calls against our leaps, also known as a poor man's covered call. So I have the SPY options chain pulled up again. So today's April the 13th. I want to sell the weekly covered calls against the SPY. So we're going to look at the next available weekly expiration, which is this coming Friday. But given that this is a short week, we're going to go with the April 17th expiration, which is this coming Thursday. And I generally like to sell my covered calls in the 15 to 20 delta range. So let's see how much premium we can collect doing that. So a 15 delta, it's giving us $152 per options contract. Let's see if we can pull some more money here. I specifically like this 22 delta. It has a lot of open interest and volume, and it is also giving us almost $1 more than the 15 delta. So I think I'm going to go ahead with this one and let's see how much money we can make. So we have 10 call options that we're going to be selling. So $254 times 10 option contracts, which is $25.40 per week. Now, you're going to do this 4 times in a month, and that will get you to your 10,160, which is our target for income collection for the month. So now that we figured out how to make the $10,000 per month by selling covered calls against our leaps, let's talk about some risk management, which is crucial in any option strategy. So in case the markets begin to fall, you could roll your position down and out. Of course, it's going to need additional capital to do that, but it's a good way to protect your position. You could roll down to a lower strike price and also roll your options out another few months. Again, if you feel the markets are falling and you think it's going to take some time or possibly a few months for the leaps to come back and profit, that's one thing you could do. If your leaps get to a point where they're 50% down, you may consider cutting your position and allocating your capital elsewhere. That is, again, completely up to you and the current situation of the market. And if you feel that your capital is better allocated elsewhere, so it's the opportunity cost of cutting your position and taking your money elsewhere in another position. Also, if the leaps are down and you're still selling covered calls against them, and if the covered calls get exercised, you run the risk of losing your leaps, which we absolutely do not want. So in that case, you want to wait and maybe pause selling your covered calls till the leaps come back in profit and then resume selling your covered calls. So there you have it. By understanding the basics of SPY and leaps, choosing the right options, selling covered calls, and continuously monitoring your strategy, you can easily make $10,000 a month. If you enjoyed this video, please give it a thumbs up, share it with your friends, leave comments below with any questions or thoughts. And I appreciate you watching, and I'll see you in the next one.